Billions of dollars, gone in minutes, not weeks, not days, minutes. If you blinked, you missed it. If you were leveraged, you felt it instantly. If you were holding paper silver, you learned a brutal lesson about how fast liquidity can disappear when everyone runs for the same door. And here is the part that should disturb you. This was not a mining collapse. This was not industrial demand evaporating. This was not silver becoming useless overnight. This was paper, contracts, leverage, algorithms, margin rules, a wave of selling so aggressive, so concentrated that the market didn't adjust. It dropped. And when markets drop that fast, it tells you something very specific. It tells you the structure underneath was fragile. Because healthy markets absorb selling. Fragile markets amplify it. To understand what really happened, you have to forget the headline, forget the drama, forget the noise on social media. You have to understand how a paper dump works. Silver trades in layers. Physical bars are only one layer. Above that sits futures contracts. Above that sit options. Above that sit ETFs and synthetic exposure products. Above that sit institutional hedges and derivative overlays. Each layer adds liquidity. Each layer also adds leverage. And leverage behaves beautifully in calm conditions. It provides tight spreads, smooth price discovery, and efficient capital allocation. But in stress, leverage becomes gasoline. Here's how the wipeout actually begins. It doesn't start with panic, it starts with positioning. When too many traders are leaning the same direction, especially long, the market becomes top-heavy. Not because they are wrong, but because they are crowded. Crowded trades are vulnerable trades. All it takes is one catalyst. A macro headline, a dollar spike, a yield surge, a margin increase, a large institutional order. Once selling begins, algorithms detect momentum. They amplify it, stop losses trigger, risk systems reduce exposure, funds deleverage automatically. The selling becomes mechanical. At that point, nobody is asking whether silver is undervalued. Nobody is debating long-term supply deficits. Nobody is talking about solar panels or EV demand. They are trying to survive the next 5 minutes. This is what people misunderstand about paper dumps. They imagine conspiracy, but often the truth is simpler and more dangerous. Structure. When liquidity is thinner than it appears, size matters. A single concentrated order can push the market into a vacuum, and once the vacuum forms, price doesn't fall in steps. It falls in air pockets. That is exactly what happened. The order book thinned, bids stepped back, high-frequency systems pulled liquidity, and what looked like a stable market suddenly behaved like a trapdoor. This is how billions disappear in minutes. Not because silver changed, because liquidity vanished. Now here is where it becomes important for you. Paper silver trades on confidence. Confidence that contracts can be rolled, confidence that spreads will stay tight, confidence that counterparties will perform. When a dump like this happens, that confidence fractures, and once fractured, it does not fully repair overnight. Let's talk about margin, because margin is the silent executioner in these moves. Most participants in the futures market do not pay full value for contracts. They post margin, a fraction of the contract's value. That magnifies returns when price moves favorably. It also magnifies pain when it doesn't. When volatility spikes, exchanges increase margin requirements. That forces traders to post more collateral immediately. If they cannot, positions are liquidated automatically. This is not optional. It is mechanical. Now imagine a cascade. Price drops, volatility rises, margins increase. Positions are forced out, price drops further, that loop feeds itself, and when it feeds itself in a leveraged market like silver, the move becomes violent. This is why the wipeout felt unreal, because once the cascade starts, there are no opinions left in the market, only math. And math does not negotiate. Now zoom out. Why is silver particularly vulnerable to this kind of event? Because it is relatively small compared to gold, because it attracts speculative capital, because its volatility is naturally higher, because industrial and monetary narratives collide inside it. Silver is both a commodity and a quasi-monetary asset. That dual identity makes it powerful in bull markets and unstable in stress. Add high leverage to that equation and you get a market that can overshoot in both directions. Now here's the deeper issue. The silver market's open interest and the number of outstanding contracts often represents far more metal than is realistically available for delivery at any one time. This doesn't mean the system is broken. It means it is built for cash settlement and rolling, not mass delivery. But when a violent dump occurs, it reveals how dependent the system is on rollover behavior. If confidence weakens and participants begin questioning settlement risk, that is when the real instability begins. Because paper markets can function with 100 claims on 1 ounce, as long as nobody demands the ounce. The moment too many participants want metal instead of exposure, the imbalance becomes visible, and violent dumps ironically increase that desire. Here is the psychological shift most people miss. When price collapses violently, retail investors panic. Institutions reassess risk. But physical buyers often step in. They see discount. They see opportunity. If that physical demand accelerates while paper markets remain fragile, divergence begins. Paper price says weakness. Physical demand says tightness. When those two signals move in opposite directions, you are not in a normal correction. You are in structural tension. Now let's talk about the largest misconception surrounding these events. People believe crashes destroy value permanently. They don't. Crashes transfer leverage. They remove weak hands. They reset positioning. They flush out excess speculation. They expose hidden fragility. After the largest paper dumps in history, silver has often done one of two things. Either it stabilizes and grinds higher slowly, or it builds pressure for a more explosive repricing later. But what it never does is forget. The market remembers where liquidity failed. It remembers where bids disappeared. It remembers who was forced out. That memory shapes the next move. Now let's address the phrase, biggest paper dump in history. Whether it was the largest by volume or not almost doesn't matter. What matters is the message. When size overwhelms liquidity in minutes, it tells you participation was misaligned with risk capacity. It tells you too much capital was resting on too little stability. And that is not a silver problem, that is a system problem. We are operating in a global environment where liquidity is tighter than it was for a decade. Rates are higher. Funding costs are elevated. Cross-asset volatility is increasing. In that environment, leveraged markets break faster. Silver is simply one of the most sensitive pressure points. Now here is the uncomfortable question. What happens next? There are 3 possible paths. First, stabilization. The market absorbs the shock. Leverage resets lower. Volatility compresses. Silver rebuilds gradually. Second, continuation. Another wave of liquidation hits. Confidence deteriorates. Open interest contracts aggressively. Third, divergence. Paper price stabilizes while physical premiums widen, signaling settlement tension beneath the surface. Which path unfolds depends on liquidity, margin policy, and macro pressure. But here is what you should be watching. Watch volatility. If volatility remains elevated, risk remains high. Watch open interest relative to price. If price falls but open interest does not contract meaningfully, leverage may still be excessive. Watch physical premiums and delivery reports. That is where paper meets reality. Watch the dollar and real yields. Silver is extremely sensitive to both. And most importantly, watch liquidity conditions globally, because silver does not implode in isolation. It implodes when cash becomes scarce. Now let's talk about you. There are 3 types of participants in a silver wipeout. The leverage trader who is forced out, the passive investor who panics, and the patient participant who understands structure. Only one of those survives consistently. If you are trading leverage, understand margin dynamics before volatility teaches you. If you are holding exposure, understand whether you own paper or allocated metal. If you are buying physical, understand timing and premium behavior. Blind conviction is not a strategy, structure is. The wipeout in minutes was not random, it was not mystical, it was the result of a highly leveraged system colliding with aggressive order flow inside tightening liquidity conditions. And if you think that cannot happen again, you have not studied market history. Silver is one of the most explosive assets in both directions. When it falls, it shocks you. When it rises, it shocks you more. But both moves begin the same way, with imbalance. Right now, the paper dump has reset the board. The question is not whether silver will move again. It is whether the next move will be driven by liquidation or by shortage. Because if the system absorbed the shock cleanly, stabilization follows. But if stress cracks remain under the surface, the next event will not be a dump. It will be a squeeze. And squeezes in highly leveraged markets are not polite. They are violent. Silver was wiped out in minutes. That tells you how fragile leverage was. Now ask yourself the harder question. What happens when the same leverage runs the other direction? If you understand that answer before the crowd does, you don't react. You position. And in markets like silver, Positioning before volatility returns is the difference between being wiped out and being ready.